Hello guys, welcome to the Train Parrot. Today we're going to talk about DCA bots. We're going to deep dive into the world of that perfect deviation that can get you out of the worst deals. We're going to compare the performance of 3 different types of deviation, and to make things very challenging, we are going to be constantly trading non-stop. I'll show you the code of my ATR experiments. For that, we're going to focus on Dogecoin, which actually has been performing pretty bad. The whole point is to find the answer of what works even in the worst of the worst cases. Guys, if you like this type of content, make sure that you're subscribed to the channel. Hit that notification bell so you get notified every time I put one of these videos. And if you feel like supporting the channel, watch this video until the very end and do not go anywhere without leaving a comment down below. Those two things are sending a strong message to the YouTube algorithm that this content is worth watching by more people. So imagine you were running a strategy using one of our best backtesters called Absolutno. Imagine you were using something extremely conservative when it comes to using DCA orders. For example, here I have a base order of $10 and a safety order of $50. And every time I fill a new safety order, I double down. That's why I use a scale of 2. I have 2 safety orders and their base deviation is 5%. You can see, for example, here a deal that has deployed the last safety order number 2, and it's quite a happy ending because the price comes back there and you take profits. The take profit is set to very low, 9%. So pretty much the whole design of this bot that I'm showing you is purely based on percentages. As I mentioned earlier, the entry is based on a signal that is printing 1 constantly. Therefore, it doesn't look for the best times to enter. It just constantly opens a new deal as soon as the previous one was closed. So let's say you are starting your bot somewhere early January and you have quite big expectations that we are going to enter into a bull run. January starts pretty flat. You continue using some safety orders. Here we can see again we use all the safety orders. Then suddenly price starts pumping on February. We do a lot of deals in this area here. There's some pullbacks. Some of them are using all the safety orders. But we continue to do pretty great throughout the first 3 months of the year. Eventually, we get into the 12th of April and we see the first scary pullback. This one in here makes 35% in a couple of days. We deploy all the safety orders with the last one around here, and still we are very close to closing and taking profit in here, but not enough yet. The price continues to dump. At some point, again, gets very close to our take profit or break even, but then it continues going down until today. And you can see that we don't manage to close the deal. In fact, we are over 40% down. So imagine you were running this bot with 2x or 3x leverage. That will mean that you have realized 40% multiplied by 3, possibly over 100% in profit, but at the same time, that realized is completely spoiled by this unrealized minus 40%. So you're 100% up and 100% down unrealized. Breaking even this year, you haven't done much and you're pretty frustrated. And you start wondering yourself, what did I do wrong? Of course, one of the most obvious answers is, why are you only doing 2 safety orders? Number 2, why are you entering non-stop, assuming that the market will go in your favor forever, and that with those 2 safety orders, with a very arbitrary amount of deviation based on a percentage, you're going to do great for a full year? Basically, gambling with your bot. So in this video, we're going to focus not on the entry. Our bot won't be able to improve in that sense. We're still going to keep opening deals constantly. That's going to be a challenge. And now we're going to focus on what can we do in terms of those safety orders. That's the only option we're going to be given during this experiment to improve the performance of the bot. And for that, so let me introduce you a couple of indicators. One is called the ATR, the average true range, and the second one is the average day range. As you can see, both of them are oscillators that are showing us the amount of volatility in the market. And what I want to do is take advantage of knowing that the volatility is currently high to elastically adjust the deviation of my safety orders accordingly. It sounds simple, but there are a few challenges that we need to resolve. For example, this deal here, which is precisely the one that causes the full mess in April and is still open at minus 40% right now. You can see that at the moment the deal enters, the volatility is very low, both on the ATR and the ADR. So the first thing I do is I don't focus on the volatility in the same time frame I'm trading. Because if you're using the ATR with a length of 14, this means that you're only focusing on the volatility of the past 14 candles of 15 minutes, which could be pretty flat, let's be honest. So the first thing that we need to get sorted is the time frame of the volatility. We're going to move it into the day volatility, and we can keep, if you want, the length on 14. Let's do the same for the average daily range. So I don't know if you see the problem, but at the moment that you get the maximum volatility, you will have already entered in your deal in here and will be already underwater. So let's face it, the volatility, even on the daily, is a lagging indicator. And the problem is that we shouldn't be focusing just on the volatility right now. We need to see the past. And we also probably want to get larger deviations when the price is on a swing high, because at that point, there's a high likelihood that we're going to do a swing low. I will assume that the RSI at this point and at this point is giving quite high numbers. So I have decided to use for safety orders initially something that looks like this. Don't worry if you don't know how to code, I'm just going to explain the idea behind this. First, I will calculate the ATR, which is something that we already show in the chart, the past 14 candles on the daily, and then I will look for the highest numbers of ATR that we had in the past 150 days, which is almost half a year, which should be one of the highest numbers of ATR that have been seen, and that number I will also add the influence of the current level of RSI, meaning that if the RSI, let's say it's 89, you might get very close to doubling that value of ATR, which is the highest in the past 6 months. So in the worst case, you're gonna get the largest level of volatility multiplied by 2 if you are on a swing high, or multiply by 1 if you are on a swing low. And that's pretty much it. It's just basic arithmetic here, and then I'm plotting these values both in the oscillator and below the price to get an idea of how does it look, that deviation. Let's go back into the chart. The white line is the actual level of ATR. The blue line is the highest in the past 150 days. You can see that is running further away from the price. And the red one is the one that, thanks to the value of the RSI, gets even further away because we are on a swing high, or it gets closer because we are on a swing low. So if we were using just the ATR, we will get a deviation of 8.7% at this point in time. If we were using the percentile version, we will get a deviation of 15. And if we were using the one that multiplies as well by RSI, we will get 22%. So let's go back into the chart and let's look at the disaster that I presented in the beginning of the video, and let's see which version is gonna come to the rescue of this bot so we can finally close this deal regardless of how poor has been our deal start condition. So I'm gonna focus on the area of dynamic safety order. This area looks like this only if you are using absolute no 098. I'm going to select first the ADR, which is the deviation that we already had in the previous version, and we can see that this is already an improvement. Instead of being 40% down, we are now barely 15% down. Of course, we have reduced the profits from 40% just to 33%, but in my opinion, this has a lot extra chances that we can close it compared to the previous scenario. Also, if we stay with a static deviation, at some point you're 54% in drawdown. That means that there is no way you can use any leverage in this situation. Imagine a 2x will already liquidate this account. What happens if we use the ATR? With the ATR, we get very close again to a minus 14%. And again, the profits are 32. And now if you use this version, which I named the Super ATR, the most conservative one, you can see that the profits are now 21%. But in our defense, we can say that we have so far used only one safety order in the current trade open, and we are minus 5% down. So this is a lot more leverage friendly. One very cool new feature that we added to Absolutno is this option to show the deviation at all times. This will give you an idea of where the safety order will be placed relative to the price at any point in time. Let's say a deal entered right there, your safety order will be placed there. So if you want to now adjust that and use a proportion, you could even say, that deviation is too much for me. I'm just going to use 70% of what's given me at the moment. By doing so, you are increasing the risk, you are increasing the profits. In this shape, this bot, I will never ever run it. This is just a proof of concept I'm putting out so you can understand better what are your options when it comes to using DCA orders in a smarter way. I tend to think about safety orders in layers. First, you start with percentages on a single coin. That's not too bad. You could potentially even look at the ATR of the full year, the worst crash, and stuff like that, and design your deviations for that sort of price action. If you leave the bot alone, that could change. So you will require to be updating that bot. Some other people put percentages with a selected group, a niche of coins that they really know. That's not too bad either if you are still doing percentages. But if you select a wide array of coins, let's say you go with 50, 100, or 200 coins on a trading bot and you put to all of them the same deviation, that is just suicide. If you really want to trade that large amount of coins, you definitely need those DCA orders to respect the volatility of the asset. Be very careful. This particular token, for example, FTN, look at how it moves. If you were to use ATR or ADR on a token like this is a massive trap. We have a daily chart and you can see for how long there is no movement. And yes, there might be a reason behind why there's very little volatility. Someone is here telling me that this is a non-volatile gaming and ecosystem token, whatever. But when you see this candle in here dumping hard out of an area of very low volatility, if you were using ATR, that will be a disaster for your bot. Because after a long period of multiple days with no, the ATR will potentially give you even a deviation of just 1%. And then you will end up deploying all your safety orders in a very tight range, which is definitely a massive trap. This bot will definitely kill ADR and ATR. And here's the proof. We are using ADR in this case, and we get the last safety order and the price continues going lower. You can see how the ATR is constantly tracking this level in here, not expecting at all the deviation is going to be much wider than just 1%. In fact, it will happen something like 8%. The problem is that this coin was listed less than 100 days ago, which means that the Super ATR cannot really do all the statistics because it needs at least 150 days in the past as well. If you want to learn more about Absolutno trading strategies, I suggest that you join my Discord server. Have a look at the strategies in here. Remember that Absolutno comes for free in a trial with the tier Observer. So I'll see you there. Take care. Bye bye.